It's a brilliant, brilliant event, and you'll come away with lots of new ideas and a better understanding of this incredible exponential world. You get to speak to the smartest people like you trying to figure this out, but also the people on stage. They're the experts. So we get all of that, all in one place, in Singapore. What more can you ask? See you at TOKEN2049.
Hello out there and welcome to another edition of Macro Mondays. I am Mikkel Rosenvold, your co-host, and with me as usual I have you, Andreas Steno, my great partner here at Steno Research.
Hey, Mikkel.
Hey, nice to see you. We have a great program today, a little bit of a special edition with a very interesting interview with your good friend Bob Elliott on the gold trade. We're receiving a lot of questions on the gold trade in the inbox, and it was about time to take a deep dive into that. So we'll get to that in a little bit. Aside from that, today, Andreas, we're going to be looking at the CPI prints from last week. And then I'll talk a little bit about the outlook for growth, one of the indicators in our macro regime model. So we'll get to that. Before we get started, Andreas, just a little clip to get started on trading the CPI numbers. Here's a little clip from X.
Good afternoon.
Or rather from TikTok. Those weren't quite the scenes here at the office, Andreas, last week. But what did you make of the CPI numbers last week from out of the US?
They were admittedly pretty soft, as we had anticipated. But I also have to admit that a lot of people had positioned for a soft print already ahead of the release. And a couple of the good old culprits showed their face again. Shelter costs and also transportation services. So, I mean, we cannot label this as a complete home run for the Federal Reserve. It wasn't bad. It was slightly below what was penciled in by consensus. But we still have that quote-unquote lacking issue of insurance costs and shelter costs. And I guess you could make the case that if you set those two components aside, we're talking about a complete green light to cut interest rates. But yeah, they're still a part of the basket, right? You cannot just fully exclude those two major categories from the overall equation. And Mikkel, if we look at the details, we'll quickly see that those two components are the ones to watch in terms of how shallow or deep a cutting cycle will get. Because shelter re-increased month on month, transportation services printed hot again. So those are the components keeping core inflation at target, slightly above target. While if you set those aside, we don't really have inflation anymore.
No. Especially in the energy sector, which has driven a lot of the inflation. One question we got a lot was the used cars part, and you touched briefly on the car insurance. I think it was last week we had a chart on the used car price indexes. Are we seeing some lagged effects here? Will we see hotter prints in the used car parts later? And how much of a role does that play?
I think it's important in a couple of months from now. We obviously had a very soft print in used cars also in line with our expectations. But if you look at live auction data, we've seen a reacceleration through the summer. And it could be relevant for the inflation basket from September and onwards, basically. So right now we're riding the wave of goods deflation. If goods inflation resurfaces, it's something that we'll have to deal with potentially alongside still elevated shelter costs and still elevated insurance costs. And therefore, I'm still of the view that we will not get to 2% inflation we will not get that print 2%. Here it is in this cycle. I still think it's likely that we bottom out just above. And that's obviously a very interesting backdrop for next year in 2026 potentially, but we'll get to that in due time.
Absolutely, but still soft enough for a cut.
Absolutely. Mikkel, the point here is that this is soft enough for the Federal Reserve to look into the labor market as their main sort of guide for interest rate cuts now. And I mean, there is a lot of stories on social media right now on the potential revision of the labor market data over the past year, especially Zero Hedge is almost channeling this out on an hourly basis at the moment. And I think there is some early merit to that story that will get some downwards revisions of the labor market data from the past 12 months. And that is on top of an already weakening trend. So I think it's fairly safe to say that we'll get a weaker labor market now. Also unemployment ticking up and all that. And that's the excuse you need as a central bank to try and bring interest rates back to some sort of neutral, slightly below neutral level, even if inflation is printing above target. So yes, they have to a certain extent abandoned that very tight guidance from the inflation mandate. But in contrast to other central banks, they have a dual mandate and they can use that dual mandate if they want to.
You want to unfuck your shit?
This is live.
Yeah, that's being recorded. Hey, listen, if you want to unfuck your future, then come and join us in the Real Vision community. Incredible platform, amazing content, some of the smartest people in the world, and amazing tools. And guess what? It'll cost you nothing. Come to realvision.com. I'll see you there, and let's help you unfuck your future.
Absolutely. After the interview with Bob Elliott, we'll touch more into growth trends. We'll look a little bit more into the dollar-yen trade that we've been looking a lot at. Yeah, Andreas?
Yeah. So I just wanted to add that, we've talked a lot about gold over the past few weeks in this show, and we broke to new high levels on Friday. I'm still very skeptical around this gold trade. It's not the worst trade in the world. That's not what I'm trying to say here. But the interesting thing is that correlations between gold and other asset markets have flipped since before the pandemic. And it makes it a very tricky asset to trade right now. Maybe it's a good asset to hold. And that's one of the main discussion points with Bob Elliott. So Bob is the former co-CIO of Bridgewater. He's now running Unlimited Funds. And he is, to a certain extent, a permanent gold fan. So I guess it's very, very timely to discuss this gold trade with Bob, also in the context of this soft CPI report from last week. It's now my great pleasure to introduce Bob Elliott to Macro Mondays. We've had Bob on the show before, and it's always a pleasure to host you, Bob. Bob, how are things?
Good. Happy to be here. Same great content one day later, I guess, is the new gig, right?
Yeah. We didn't fancy working on Sundays, so now it's a Macro Mondays show, right? But Bob, you're the CIO of Unlimited Funds, former Bridgewater as well. And you've been a vocal bull around the gold price on SoMe and in various media outlets over the years. And I'd like to take a discussion with you on the gold outlook, given that we've received so much feedback on the gold price amidst this discussion on when the Federal Reserve will cut interest rates for the first time. But before going on there, we received a lot of good news from the U.S. economy, basically, through the latter part of the week. And Bob, is it even feasible to discuss a rate cutting cycle of the magnitude that is being priced in right now?
Yeah, well, I think, a lot of folks who are following markets are really focused on, is the Fed going to cut or not in September? But when you're thinking about trading markets, the key thing you got to focus on is what's likely to transpire relative to what's priced in. And what's happened over the course of the last couple of weeks is the data has become more confirmatory that the Fed will, in fact, cut interest rates in September. But what's happened is the market pricing of the Fed's cutting cycle has become substantially more extreme, to the point where, depending on exactly the day, we're looking at between 7 and 8 cuts, 825 basis point cuts between, September of this year and September of next year. A 200 basis point cutting cycle in 12 months is about as fast as a cutting cycle would be in a normal recessionary environment, a significant recessionary environment, not just a growth moderation, but a recessionary environment, and probably only eclipsed during periods of extreme financial stress. And then you compare that to what's going on in the economy and the data that you note that we saw in the later half of this week, and nothing in the economic landscape really is pointing to an acute slowdown that would be, where 200 basis points of cuts would be appropriate.
So, Bob, this recession discussion, given retail sales printing at 1% month on month, given initial claims still tracking towards lows, etc., is it feasible to discuss a recession scenario this year, or is it more of 25 story? Where are you on that recession discussion?
Well, what we're seeing in the U.S. is basically we're seeing a very gradual eroding of growth as a function of persistently elevated interest rates, but it is gradual to say the least. And I think there's a lot of focus, for instance, on the U.S. unemployment rate, which has moved up more acutely in the last couple of months, but in part due to some probably likely transitory factors related to temporary job layoffs, as well as new entrants, which isn't necessarily a bad thing in a labor market, particularly when you see labor force participation at multi-decade highs. And so, we're basically in this scenario where, yes, the U.S. economy is slowing. I think there's lots of different places where you could see it. I wouldn't get too focused on, retail sales was very hot. It's probably not. The economy is not quite as strong as that would suggest. It's not quite as weak as what the unemployment picture would suggest. It's gradually moderating. But look, we're talking about growth that is in the range of 2 to 3% real, and inflation in the range of 2 to 3%. And stocks basically at all-time highs. You put that combination together, like, what is the rationale for an aggressive easing cycle here? It just doesn't hold up. And I think that's the biggest gap that I see in the market right now.
If we look at the dual mandate of the Federal Reserve, they obviously look at both inflation and labor markets. And since June, we've received a couple of soft-ish inflation reports, and unemployment has started ticking up. So how do you think they will weigh those two mandates against each other, given what we've seen lately from the U.S. economy? Is labor becoming more of an attention point for the Federal Reserve here?
Well, I think they're going to weigh these things. Probably the most important thing is cautiously. I think the Fed, if you go back and look, let's say on the inflation side of things, the Fed has been caught wrong-footed on the forward-looking picture of inflation a couple of times over the last couple of years, in early 2023, and then at the end of last year, where Chairman Powell took a bit of a victory lap, and then all of a sudden the data didn't comply with his victory lap, and so it makes sense to me that the Fed is going to be cautious about extrapolating a couple of good prints, which it's definitely a couple of good inflation prints, just extrapolating that out and saying, look, I'm just going to take that as a given that the recent couple months of prints are going to be inflation where they printed. I think they're going to need to see more evidence, certainly before they think about saying, hey, look, we're going to proactively cut rates in response to weaker inflation. And so that, I'd say, is cautious there. And then on the employment situation, we've transitioned from a point where employment was secularly tight in the U.S. economy to one in which, employment has moderated, has loosened a little bit. But as Chairman Powell mentioned in the press conference, most of the loosening that we've seen so far is what you'd almost call good loosening, in the sense of wage growth was too hot, the labor market was too tight. We've gotten a very nice increase in the supply of labor. Like, if you're going to loosen the labor markets, that's how you want to loosen the labor markets, is through millions of folks coming into the labor market and getting employed and getting jobs. We now have, whether it's employment, prime age employment as a share of the population, or prime age labor force participation as a share of the population, that is basically at multi-decade highs. That's a good labor market to have. And so I think they're not going to just extrapolate, hey, look, the unemployment rate's risen, and so we're just going to, we're just going to pencil out that things are deteriorating rapidly. They're going to want to see that additional data. And they're going to get some additional data between, now and when they make their decision. And that'll be an important consideration. Odds are, it looks like that will be a bit stronger, a bit more positive than what we saw last month when it comes to employment. And if we're seeing sort of inflation continue to be roughly here, employment conditions a bit better than the sort of trend that we've seen in the last couple weeks, we'll see a 25 basis point cut in September, but it's not going to be, hey, look, we're, dropping rates aggressively in response to a slowing economy. It's going to be, frankly, kind of like what the ECB is doing. It's like, what is the ECB doing? Like, they cut 25 basis points and then they all went on holiday in August. And, we'll see when they come back to do something. It's probably going to be a little while. So, it's kind of like that feel of it, rather than something that's like an aggressive cycle.
Yeah, it kind of reminds me of a very, very hilarious meme I just saw a few weeks back, Bob, with an example of an out-of-office message from a European employee stating that they're off 6-7 weeks over the summer. And the US equivalent to that out-of-office message was, I'm having a kidney surgery, but here's my cell phone number. Is something urgent? But you're absolutely right on the ECB. They are in no rush to sort of deliver panic cuts. And let's see whether the Federal Reserve will follow that playbook. But one of the questions we get each and every time interest rates look set to drop is whether this is a good timing to enter into a gold trade. Gold is obviously some sort of money, and we typically see, at least over the long term, a correlation between real interest rates and gold prices. But that correlation broke down in 2022 due to the Ukraine war and China buying gold, etc. So how do you view gold in the context of a cutting cycle most likely commencing in September?
Well, Andreas, gold is always a good thing to add to your portfolio. And I say that a bit tongue in cheek. I think structurally, if you look at most portfolios, very, very few investors hold gold strategically, like in their savings portfolio. And we could fill a full podcast about all the reasons why gold from a portfolio diversification perspective makes sense. I can boil it down to something relatively simple, which is, look, gold outperforms bonds about half the time when stocks decline. Yet essentially everyone holds bonds and no one holds gold. And so if you're thinking about a stock diversifier, gold makes a lot of sense to be a diversifier to your stocks in the same way that bonds do. And so it makes sense to add to your portfolio since you're probabilistically underweight gold. And we've seen that benefit play out over the course of the last 5 years very clearly in terms of gold being a better portfolio diversifier, a better asset to be holding. So, I say it sort of tongue in cheek, like, hey, you almost certainly are underweight gold in terms of your strategic or your savings portfolio. And so you should think about it. I think tactically, look, gold, relatively simply is non-interest bearing money. And typically when you see, an expected decline in interest rates, gold tends to outperform. Gold is also a tail risk hedge, whether it's in particularly high inflation environments, low inflation environments, or rising geopolitical concern environments or fiscal profligacy environments. All of those things are probably underpriced in aggregate in the market in terms of particularly if you look at things like the pricing of conflict or prospective conflict is very low. The pricing of and the implications of deglobalization is very low. Bonds are certainly not raising any in the U.S. and other developed economies, not raising any concerns about problems with fiscal expansion on a forward-looking basis. And so I think all of those reasons from a tactical perspective align with the fact that, gold is a nice diversifier, particularly maybe you're sort of stronger on stocks or the economy. Gold is a nice asset to be holding on the other side of that position as well, that can provide some good diversification, tactical diversification in those scenarios.
So one of the things I've been looking at in relation to this gold trade, Bob, is the volumes traded out of China and Asia overall. And it's been interesting, to say the least, over the past couple of years to see how many Chinese high net worth individuals, we've seen a lot of them buying gold to gain access to the dollar, it seems, in a regime where the dollar has been very, very strong versus Asian currencies, especially the Japanese yen, but also to a certain extent the Chinese yuan. And judging from gold flows, it seems like Asian gold flows more than outweigh Western gold flows. So a couple of questions in relation to that, Bob. Do you think it's relevant to the gold trade if the dollar turns versus these Asian currencies? And secondly, why are Asians much more active in gold relative to Westerners? Because that's simply what we can see from the flow picture.
Yeah. Well, I think, first of all, just in terms of the composition, it's very important to when you're thinking about gold is a global asset. It isn't a U.S. asset or a Western asset. And I think part of what folks, particularly from a Western, and I'd say particularly from a U.S. and U.K. perspective, have basically eschewed gold because they've never lived through experiences where gold as that tail risk hedge was a critical element of a portfolio. If you, if you're from Germany, if you're from many emerging economies, you have either lived through or people who have lived through significant drawdowns in financial asset wealth as a function of inflationary environments or geopolitical problems. And so it's actually not that surprising. Like if you look, the vast majority of the world, certainly on a population weighted basis, finds that gold is their base currency, their risk neutral currency, right? Their paper currency is their risky currency, and gold is their risk-free currency. And I think that's important when we turn to the Chinese circumstance, where, yeah, it's true. Like Chinese supply and demand is a huge driver of what's going on. There's obviously the central bank purchases, which have been a big driver of gold demand, sort of structural gold demand. But now seeing the retail side of it, I mean, like, look, we could talk at length about the Chinese situation. I'd simplify it to say, look, they're undergoing a deflationary depression, and their central and their the policymakers are not making decisions maximizing economic outcomes, and will likely need to experience a lot more pain before they do so. The way that pain has played out, that sort of pain has played out many times in history, is that currencies get devalued relative to stuff because it's the only way to get out of that deflationary depression. And that means their currency is getting devalued relative to what's going on, relative to hard assets, and relative to hard assets. And so it's not surprising that people are moving towards gold as their sort of base savings portfolio to protect themselves against that circumstance. And I'd add the additional challenge in China is like, what else are you going to actually invest in? You can't get your money out of the country. I mean, anyone who can is trying to get their money out of the country, but you can't really get it out because of capital controls. You're going to buy stocks. That has been a terrible trade. You're not going to buy real estate. That's been a terrible trade. You're not going to buy wealth management products. That's been, those have gone belly up. Like, what are you going to buy? You can't buy Bitcoin because it's illegal. You see a little bit of pressure related to that, but like literally there's nothing else left, like other than buying jewelry and physical gold to protect yourself. There is no other asset available for onshore investors. And so it's not surprising they're turning to that.
Bob, you're running unlimited funds seeking to sort of create portfolios with return characteristics relatively similar to the hedge fund industry. And the final question I have for you, also based on your experience from Bridgewater, how active are hedge funds in precious metals? Is it something that we see traded on a running basis in these very active investor strategies?
Well, I think a lot of folks in the precious metals, myself included, have spent many years trying to figure out sort of core fundamental drivers of precious metal supply and demand. And the reality is pretty tough. In the way that, it's relatively straightforward to connect, bond market, short rate pricing, stocks, et cetera, to macroeconomic fundamentals. I think when it comes to things like gold, it's less fundamentally driven, more sentiment driven, and more sort of physical supply demand driven. And so in order to really understand what's going on in the gold market from a tactical perspective, you got to get down to that physical supply demand, in terms of, who's buying, why are they buying, what are the magnitudes, et cetera, et cetera. And I think that is, that's a challenge, for many investors. And so I think when you look at it, most investors, most tactical investors are not really trading gold in substantial size because it is such a challenging asset to trade tactically. And that's, why I joked on Twitter when we were talking a little bit, gold is, an asset to hold, not an asset to trade, in contrast to many other financial assets, which are the opposite.
Mm. And in all transparency, I actually do hold a little bit of gold in my structural portfolio, and then I've bought a put in my alpha portfolio. So I'm basically crossing spreads here in a sense, but I'll leave it at that, Bob. It's always a pleasure to talk to you here at Macro Mondays, and thanks for enlightening us on both the gold market and the short-term interest rate market. Bob Elliott of Unlimited Funds, thanks for joining us.
Thanks so much for having me.
Back after the pre-recorded interview with Bob Elliott. Very interesting stuff there, Andreas. Let's round off the show with a look at outlook for growth.
Yeah.
So you posted your Steno Signals article this week, taking a little bit more of a deep dive into what goes behind our macro regime model.
Yeah.
We positioned the macro regime for August on QE like.
So far, so good.
So far, so good. But there are some trends pointing in various directions. Obviously, the main movement here was that growth perhaps could be turning downwards. Yeah. You posted this chart on the growth factor weakening materially. What are we looking at here, Andreas? And why is the growth weakening right now as you see it?
So this macro regime model is a daily nowcast, transferred into a probability of rising liquidity, rising growth, and rising inflation. We've seen a downwards trajectory on the probability of rising inflation basically since May. And we're now at more or less stone dead levels, if I'm allowed to say so. I mean, there's not really a high probability of inflation flaring up right now. It's very low, actually. On growth, we had a very, very strong first half of the year, as you can see, all the way until early summer. Yeah, and I think what happened during July was essentially the thing that wrong-footed a lot of people. And admittedly, we also talked about some sort of gung-ho style market through June into the early innings of July, and you can just take a look at the show from late June, for example. That was kind of still the vibe, as in inflation was receding. That was very positive for markets, as liquidity trends were improving all the way into the early summer, and then they started weakening as well, alongside the weak growth. So what we do here is that we use real-time data on liquidity, on inflation, and on growth to assess the probabilities. And this was the exact reason why we managed to navigate July without losing a lot of money, even though we had some a different view when we got into the summer. I have to admit that, but this is a very agile setup, right? I mean, it could change swiftly, and as you can see from the chart right now, the difference to July right now is that we're starting to see some positive signs out of liquidity. We've touched upon that also in our special edition towards the end of July and early August, and that's why we're in some sort of QE light scenario. It's not QE really, but it works as QE with liquidity improving a little bit, while both growth and inflation is on the floor. And that is a better market environment than what we had in July and early August. So for now, I think we've managed to time this pretty well outside of the gold trade. Maybe I should mention it more times now. Yeah.
Just to be specific, Andreas.
Yeah.
The reason why this could be wrong is that this is not based on CPI reports and GDP reports, etc. These are nowcasts of trying to get ahead of the official numbers in growth, liquidity, and inflation. And that's why, obviously, there is a margin of error here, because these are attempts to gauge these numbers before they're official, essentially.
Yeah, sure.
Just to give you a further glimpse, perhaps we can dive into this, which shows the likelihood of the various regimes over time during 2024. And as you can see, it's very rare that you get. We had it early in this year, a very clear signal on which regime is the prevalent right now. It is an assessment of which is the most likely to occur. Yeah. And obviously, the strength of that likelihood is also determining for what trades to do based on this.
Yes, absolutely. And I think there are two negative regimes, basically. Either the one I've labeled run for the hills, so inflation rising alongside weak growth and weak liquidity, or else the regime that we've labeled down, 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 so both liquidity, growth, and inflation falling at the same time, momentum-wise. Run for the hills being the worst, quite obviously given the name, but down, down, down is not a positive scenario either. And we had both of those regimes pretty much at the forefront of the developments through July. It's starting to look a little bit better, as you can see on the chart here in August. It's not looking overly good. We saw some momentum in the most positive gung-ho regime, but the most prevalent regime right now is the QE-like or QE light regime, where liquidity is the only part of the equation sort of holding risk asset markets up. But it's been sufficient to keep things afloat through August. And yeah, we need a stronger momentum behind the two very bad macro regimes to flip the portfolio in a negative direction again. I'm not ruling it out in September because, some of these trends typically weaken a lot in September, especially on liquidity. So let's see. By the way, as a teaser, you'll see a lot more of this on the platform in coming weeks. It is a daily live signal, which will allow you to sort of guide your ins and outs of risk asset markets. I find this was basically what saved us during the summer, because, even if I do my best and try to predict like 3-4 months ahead, you cannot really do that with a high degree of certainty, and therefore having this signal live is very useful.
Much more of a tactical view of this. Okay, Andreas, enough about models. Let's get actionable here with commodities. No, I'm sorry.
Yeah, but that's it's actually a good
one.
It's a good entry point to discuss commodities, because one of the things that annoys me right now is that dollar yen is starting to move lower again, and we obviously saw how the dollar yen trade was kind of an early warning signal during July, and this chart is very telling. We had dollar yen trading above 160, while real rate spreads moved in the opposite direction. Bank of Japan is still hiking. The Federal Reserve is soon cutting. So obviously this trend has turned, and we're now closer to what I will call new equilibrium levels, but we're not there yet. We're talking maybe 142, 143 in dollar yen, given current interest rate spreads. And again, Monday morning, we saw a major sell-off in dollar yen alongside some weakness in Japanese stocks. So this is one you need to watch again. I'm pretty sure that we are not in a similar vulnerable scenario to what we had in early July, especially since dollar liquidity is doing better. But if the dollar liquidity tide turns a little bit into September, this is clearly something that holds the potential to also weaken both commodity markets and equity markets again. Why is this relevant for commodities? My thesis, and so far it hasn't really played out in gold, but it has played out in other metals, is that metals provide Japanese high net worth individuals and Chinese high net worth individuals with a very direct access to dollar liquidity. So if you hold a gold bar or a silver or copper for that matter, you can just sell that and gain dollars. And when we saw the tide turning in dollar yen, we also saw a landslide in the silver trade. We were thankfully on the right side of that. We also saw a landslide in the copper trade. And those were some of the components that basically saved our portfolio through July, as we were on the right side of that short commodity trade. The only commodity that is yet to sort of cave into this pressure is gold. But I can more or less guarantee you that the Asian gold flows will fade or abate due to this. Because why buy gold on a marginal basis if your currency is gaining versus the dollar? And we also see the Chinese currency gaining a little bit versus the dollar, by the way. So it will take some of the steam out of the Asian gold trade. Right now, Westerners are buying gold. For good reasons. I get why. I mean, geopolitics, lower interest rates and all that. But you'll not necessarily be aided by the Asians. And that's why I'm still not overly convinced that the gold trade is a good idea.
Okay, Andreas. And what else on the, if we just sum up on the silver and copper trades, we've been receiving a lot of questions in. What's the timing of getting out of those short positions?
Yeah. So we, in all transparency, we sold silver on Friday. I mean, the price action basically started to moving a little bit against us in the shorts. So, I mean, why not take some profits? And I'm still of the view that the commodity trade looks very vulnerable. Especially given what we see in priced inflation in markets. I mean, there is a major gap between inflation expectations and commodities right now. So that gap probably has to close either from above or below. I think the most likely is that the commodity market will remain weak here. The interesting thing is that we see very weak imports in China of various metals right now. The aluminum trade is doing poorly. The iron ore trade is doing poorly. So I guess this Chinese commodity cycle has wreaked havoc with a lot of these super cycle fans out there. And I'm not really convinced that the Chinese cycle is doing well at the moment, especially not the domestic cycle and the real estate cycle. Remember that on a marginal basis, the real estate cycle was the most important driver for metals, especially base metals. And that tide has turned, basically. One final thing I'll say on this, Mikkel, is that we're running a regime model on the US, and we showed you that in the show. We have the same kind of methodology for China, for Europe, for Japan, etc. And you'll see more of this on an ongoing basis. Daily signals from each of the big economies. And there's a big gap between the export momentum in China and the domestic momentum. The domestic momentum is absolutely on the floor still.
Yeah, there's some question marks to their to the oil demand, especially out of China as well.
Yes.
We may touch more on that next week. Could be another joker to the inflation picture. That's essentially all we had for you this week. Remember, you can read a lot more of this stuff on stenoresearch.com. Please feel free to add questions or ideas for future shows in the comments section. Other than that, only left for me to say thank you a lot for watching. We'll be back next week.
Sometimes it may be good, sometimes it may be shit.
It's a brilliant, brilliant event, and you'll come away with lots of new ideas and a better understanding of this incredible exponential world. You get to speak to the smartest people like you trying to figure this out, but also the people on stage. They're the experts. So we get all of that, all in one place, in Singapore, What more can you ask? See you at TOKEN2049.
We hope you enjoyed the video. At Real Vision, we help you understand the complex world of finance, business, and the global economy with in-depth analysis from real experts. Join the revolution at realvision.com.